Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. There's a comment here I'd like to comment on. I do see this every once in a while, this question. The question is, all indications are showing a slowdown in the economy coming, which in turn, that would mean yields will start coming down later in the year and possibly into recession. How would that affect your commodity outlook? Would they be where or would they be some commodity would there be some commodities not to hold during a recession? Well, I think there's a couple of things there that you're saying, and I don't know if I agree with the entire givens that you have there. It says all indications are showing a slowdown in the economy coming, which in turn that would mean yields will start coming down. Is that a true statement? The statement that if we have a slowdown in the economy, that yields would start coming down. I think it highly depends on inflation. And inflation comes from, in my opinion, the loaning growth of against new homes. So it's the volume of new homes being built and the loans against that. If that is increasing, you get inflation. Inflation is what causes bondholders to sell. The economy and the strength of the economy is not what drives yields. That's why we've had a 40-year decline in interest rates with very strong economies. In the 1970s and 60s, we had, and 40s, 50s, 60s, 70s, we had strong and weak economies, but we had high rates of inflation. And that's why interest rates went up. So I think that the economy and yields are two separate things. Yields go up when we have inflation. Inflation goes up when we have a strong real estate market, which is not necessarily tied to what maybe you consider to be the economy or the stock market. Some people confuse those things. The economy is not the stock market. And assets get priced differently based off of interest rates. So if the economy, if it's not kicking out product and we've got inflation from the real estate market, that's known as stagflation. I pulled up the definition of stagflation. It says stagflation refers to an economy with little to no growth and higher than normal inflation. The US has seen it happen before in the 1970s when the so-called misery index, or the sum of inflation and unemployment, reached 19.9%. So you can have unemployment go up and have the housing market go up at the same time like it did in the 1970s. You can also have an economy with little to no growth like the 1970s and have high rates of inflation and high interest rates. The interest rate is going to impact stocks. And that's why if I were to pull up, and I'll pull it up here, guys, I'll get in here and knock this all out because this is important to understand. So if we have, I got to get to the S&P 500 here. Let me scroll on down. Here's the S&P 500. I'm going to back way out. This time frame from 1968 all the way till 82 was the bottom. 1980 is the peak in the housing market or so, late 70s, early 80s. And we had an expansion phase of real estate, which was very inflationary during this entire period, where stocks basically went sideways. This they would consider to be an area where it was not favorable for stocks, but very favorable for commodities and precious metals. Why is that? Are those market conditions so favorable for a commodity boom? And why am I a big commodity precious metals guy right now? Well, it's the market conditions. The market conditions that were in the 70s are very similar to what we have today. We have shortages of commodities coming up very soon. That includes a wide array. And you've heard the guy, Jeff Curry. Jeff Curry? Yeah, let's pull up a quote by him. Jeff Curry molecule. Let me see if he's got the liquidity one. So here it is. I'll share it. It says Goldman commodity veteran says he's never seen a market like this. And I don't know if I can have Bloomberg here, guys. And what he says, and I'm grabbing this from Bloomberg Energy, it says, this is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, aluminum. You name it, we're out of it. Jeff Curry, the head of commodities research. Now, I was reading a bunch of different articles. I read a whole bunch of different things. I've got my viewpoints, but Jeff Curry actually said a couple of things that I completely agree with and that I've held those views. Now, and I'm going to prove to you kind of what those views are. So I'm going to pull up some charts here. Give me 2 seconds. I'm going to pull them up. Get me out of here. And what I'm pulling up, I'm going to show you something. And what I've got here is the gold to monetary base ratio. And this was the decline in the 40s, 50s, 60s, and then the eventual revaluation of gold in the 70s. What is important here to understand, and I'm gonna dance all around your question, okay? They printed a bunch of money, but the market conditions and how they held gold. Gold was held down here. You could see that the gold to monetary base ratio went way low. What that means is that the pricing of gold did not account for the monetary base in the system. And when it was freely traded, you could see this revaluation occur where gold accounted for the money supply, and this ratio went back to what I would consider to be more of a normal level. So on the right-hand side here, and why this is kind of different, is we've had a very long decline in interest rates. And if I were to look at interest rates, we went from 1980 all the way down to about now. And interest rates are starting to break to the upside of this downtrend line. What has a huge impact is this is the decline of interest rates. We had a liquidity event caused by the housing market from 2000 to 2008. That's what this little blip is. And then we came back lower. Now, what could potentially happen with interest rates breaking to the upside here? And I'm talking about the right-hand side here. If this breaks and does something similar to the 40s, 50s, 60s, 70s like this, if it starts going back up, what huge impact that can have is, and this is like game-changing, all right? If it goes up and it goes up fast enough, long enough, high enough, however you want to say it, there's going to be triggers that trigger the rotation of money, of assets. All that money went into stocks and bonds. And with the housing market, the housing market's driving the inflation. The inflation is driving bondholders to sell because they have a real negative rate. And if interest rates go up, it's going to put pressure on bondholders to sell because they will literally be losing money. If interest rates go up, you could see bonds get smoked because they're going to lose money. Bondholders, when interest rates go up, bonds lose money. They go down. And if we go into this new environment, what I am speculating on is that rotation of money is going to occur, and this is going to revalue higher. Gold's going to revalue higher because money cannot be stuck in bonds, or it's not going to prefer stocks either. And stocks have been priced to the very highly because we've had such low interest rates. We saw that 40-year decline in interest rates. So the economy doesn't drive necessarily inflation. Inflation is driven by loan growth. Loan growth is driven by the loans being put against new homes. And I think that will continue irrespective of what the economy does. Now, we also have shortages in commodities coming. That is going to be an inflationary pressure. If we see large commodity price increases, you're going to see large inflation increases in your consumer price index. That is what transfers that inflation into the consumer price index. So under these market conditions, I think the economy will have to go down. I'll say that again. I think the economy will have to shrink. It will be slowed down because we will have shortages of things. Now, inflation will be very bad in a scenario that I am describing, and we'll see how it all plays out. We'll see, because I don't have the answer. I mean, back in the 1970s, they basically had a very large amount of energy, surplus energy in the world. The United States came into an energy crisis. In the beginning of 1970, we had peak oil in the United States. We had a decline in the production of oil, and then we had to become an importer of oil. Now, there's no more place to import oil if the entire world runs into a shortage of energy or oil. And I don't think having a crisis in commodities in terms of a molecule crisis, that's what Jeff Curry says. I'm using his words. If we have shortages of certain materials, I don't think it's going to be easy to ramp up renewable energy. I don't even know if renewable energy has the energy return needed to sustain complex societies. Its intermittency and its inability to store electricity, and then all of the minerals and energy it takes to get all those minerals. I heard that its energy return is 3.5 to 1. But you also have to think of, if it's 3.5 to 1, you also have higher energy efficiency transferring electricity than you do with energy from fossil fuels. So fossil fuels, you might be 30, 40% efficient. Electricity is more like 90% efficient. So there's also those efficiencies. So if we were to do some quick math, just to kind of show you and compare it, I think to an equal playing field here. If it's a 14 to 1 return, 14 times if the energy content is, let's say, 0.35, it's about 5. Let's say it's about 5. If it's only 3.5 and you times it by 0.9, it's 3.15. Divided by 5, that's a 63. So you're getting 63% more energy, we'll call it, of real energy instead of energy being wasted to heat and whatever if you're burning it in an engine. It's still 63% more efficient than what we currently kind of have. So, or what the minimal amount of the economy needs. So, if you were to look at it from an engineering standpoint, I'll just throw it out there. Renewables are the worst thing that you can implement. If you implement all of these renewables, it doesn't have enough energy return to sustain life in a complex society. The more that you implement, the higher the cost of all electricity is going to go. Of those countries that implement this, that's probably why you're seeing the increase of cost of that. Plus, they have to do redundant systems. There's no point to put a whole bunch of renewables in if you have to build another natural gas plant. Might as well just build a natural gas plant, run it at 95, 100% efficiency, whatever you can get to the closest to 100% efficiency. Nuclear and all these other ones, you have to run them you can run them at high levels of efficiency, and you also have a stable baseload power. Renewables don't have that. So then, if you're going to put renewables into the system, irrespective of how cheap or expensive they are, you're going to have to buffer their intermittency. The buffering of the intermittency puts limitations on how much you can put into the system because you can't buffer that intermittency. So you're constrained to only using so much. It's not a very good power generation source, and its intermittency kills its energy return on investment. So if you need 1 gigawatt of stable power or 1 megawatt or however you want to say it, you're going to have to put in 5-10 times as much or 4 times as much to get a stable output of that amount. Because remember, it's only 30% or 20% or 15%, depending on if the wind blows, depending if the sun's out, depending if there's clouds. And I'm not anti any of this stuff. I just don't see it's not that good, and we've barely implemented anything. And anybody who's implemented the most renewables have the most problems. They also have the highest cost of energy. So these people who may spout that solar is super cheap to put in, it doesn't work in practice, and that's all that matters. You can be in theory all you want, and a lot of engineers get tied up in theory, but it has to work in practice, and that's where all the refining happens. You have to refine it and refine it and refine it so it works in practice. Now, I know I'm kind of venturing off from the original question. The original question is, if the economy and yields, I think yields will continue higher, period. Why do I think it's going to continue higher? Inflation from the real estate market, and it's not tied to the economy. The economy is going to come under pressure from energy. Energy is going to blow things up. That's what I think. The economy is going to crash, or the economy is going to have a problem because it's starved of energy. And the starving of energy will also starve everything of commodities. So I don't know how renewables will fix this, because renewables are going to need a bunch of oil and natural gas and coal to dig it out of the ground with cheaper energy prices. If your energy prices go up, your renewables become less. Their biggest input of renewables is the energy cost. And if energy costs go up, renewables become less cost justifiable. At least that's what I've read with a lot of certain things. So the way that renewables have become so cheap is because commodity prices were at 100-year lows against other assets, and energy prices have been very cheap and plentiful. If that reverses, I don't know if renewables are cost justifiable. If energy is the highest input for renewables, and the commodity inputs, what if those commodities aren't there to build them? Cost doesn't matter then, does it? I mean, we'll see. We could see large shortages in aluminum, copper, nickel, everything. And I don't know how they're going to rectify this. And if they are going to rectify it, and let's say we completely replace our copper production, which maybe our copper production's at 1%, 1.5% of the old mines, everything's declining in ore grades, everything. So if a whole bunch of elements come off the elemental chart in terms of, not in its entirety, but they just have shortages of it, the engineers are going to have one heck of a time trying to re-engineer everything. So maybe they're going to have an engineering boom based off of re-engineering everything, engineering out, or trying to engineer out as much nickel, copper, a lot of the rare earth metals, because we're not processing this anywhere. All the energy, you're going to be left with like nothing. But we'll see what happens. And the money in this type of, in my opinion, in this type of environment or market conditions, I think the economy is going to be very weak. I think interest rates are going to go up, and I think gold is going to revalue itself far higher. And I think we're going to have problems with producing and mining all of these minerals from many aspects. Many aspects being that people don't want this dirty, environmentally destructive process occurring. So they're going to block these things. And I don't know how you're going to replace existing production with a bunch of low grade, a bunch of low grade mines. And low grade mines require far more energy as an input. So are we going to have the largest renewable energy boom under a scenario where we have shortages of all the commodities it needs? What are the commodity prices going to do? They're going to go rocketing higher. Then in turn, solar and wind and all these other ones are going to become less competitive. We want to conserve the commodities, not blow them up. And then, if you just look at it from a logical standpoint, just silver by itself, I'll just use silver. There's like something around 800 or 900 million ounces of silver produced. Each solar panel, it's something like, you know what? I don't want to quote it, but each solar panel requires a certain amount of silver. If we just took and tried to implement everyone to have solar panels, you would run out of silver in like one country. Like if we tried doing it just in America, we wouldn't have enough silver. So how are we going to do this on a worldwide basis? Well, we can't. I'm just kind of thinking and looking at this stuff. I mean, even all the copper that's required, we're coming into a period where we're going to have to put major investments in a lot of things. And if you read the book Limits to Growth, this was one of the downfalls. You can't majorly invest in everything all at the same time. So it's not like we have one little shortage somewhere. We have a massive energy shortage in coal, natural gas, and oil. So then that's going to require massive energy investment to sustain that, massive energy investment to go whatever's next, massive investments in the commodities that are needed for this. I just see it as a world that is coming up with shortages. That's kind of how I'm viewing this, and I'm putting my money where I think the greatest shortages could be possible. I'm trying to actually help and solve the problem by putting my money where I think it's needed. In a world where you have excesses of everything, a world of excess in energy, an excess of commodities, an excess of everything, well, yeah, people are going to speculate in the intangible world. But what happens when all your tangible things go away? All that money is going to go away from the intangibles. It's going to go straight to the tangible assets. And I think people are figuring that out. That's why commodities are having such a big run. Now, you have to also keep in mind, commodities are at 100-year lows. All of the money went into stocks and bonds. That has to rotate back. I think that we're going to see an era where money prefers tangible assets. Tangible being physical gold, physical silver, physical platinum, into commodities. Why? Because that's what is required for an intangible world. Intangible assets eat tangible things. Intangible, people speculating in crypto and all these other things, it's eating up a ton of energy. It's eating up a ton of tangible items like computers, graphic cards, silver, everything. You can't have an intangible world with no tangible things. And I know I'm going to an extreme here, and I like to go to the extremes to make a larger case. But I do think that we're going to see a slowdown in tangible items. The abundancy of everything is becoming a lot less abundant. And we're going to have to start thinking of how to use the tangible items in the most efficient way, because they're not as abundant as what they used to be. So I think that the pricing of all this is going to go far higher. I think it's completely mispriced. We can see it in the ratios. We can see it where the money has flowed in the ratios. We can see all these things, but I do think the economy will come under pressure. We could crash, and commodities may or may not go down. I don't know. It's a really difficult question because the very thing that's causing the crash is that thing that will be short, is the commodities. So it's difficult to say how they're all going to react with each other. And you could probably maybe even see wars over this stuff. Nationalization, wars, higher taxes, people protecting their strategic reserves of whatever they have. It might be that everything becomes a strategic reserve at some point. Remember, Limits to Growth, that book, they said somewhere around where we're at today, we would be hitting limitations of those commodities. And we've been in a really easy period, a very easy period of 40-year decline. We've had a little bit lower, I should say slower growth in some areas of population and demographics. America is what I'm referring to. But I'm just kind of talking in general that we'll see what happens. And as of right now, everything looks game on to me, because we've got increasing home prices, increasing housing starts, which is inflationary, increasing interest rates in general, and yeah, that's what we've got, which is a mix for higher commodity prices and higher precious metal prices and higher real estate prices, and that is a commodity boom. That's the signature. I don't try to guess when a recession is going to come. I have to see it, and usually that's led by the housing starts. So I think the stocks will pull back. But stocks doesn't mean we'll be in a recession. They may call it a recession if it's a 20% decline in the stock market. But yeah, we'll get that. We'll get a big pullback in stocks, but I think commodities will continue higher, at least for the time being, until I see the housing starts go down. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.